Hello. In this video, we're going to go through the physical units that are included in your inventory amount. When you think about your inventory, you mainly think about the items that are in possession for your company. Meaning, if I'm a clothing company and my clothes that I buy from my supplier, those go into my inventory. That's the kind of items that you typically think are included in your inventory. Excuse me. But there are other items that you also have to consider that are also included in your inventory amount. One of them is the goods that are in transit, and we'll go through each one of these. Another one is if you anticipate any sales returns, any items to be returned, those returned items need to be included in your inventory. And if you have any goods on consignment, those need to be included in your inventory. Let's talk about goods in transit. So goods in transit are for items that are in transit. So if I'm a clothing company and I buy my supplier, my vendor is, let's just say, Nebraska, and I am in California, and I placed an order, and so my seller, I'm the buyer, right? Because I'm in California, and my seller is in Nebraska, and the seller ships my goods to California, and they ship it on 12/28, but it does not, December 28th of a year, and it does not get to me till January 5th. Well, the question is, while those goods are in transit in that truck driving from Nebraska to California, who owns that inventory? Is it the seller or is it the buyer? And the answer to that is it depends on the shipping terms, which are predetermined as part of the acquisition of the inventory. So here we have an example of goods that were shipped from a company on December 29th, and they didn't arrive to the buyer until January 3rd. So here's how it's determined who owns that inventory. If the invoice, and the invoice will have the shipping terms, this is called the shipping terms. There are two different shipping terms. The first one is FOB shipping point. If the shipping term says it's FOB shipping point, that means that as soon as that merchandise leaves the seller, then the title transfers to the inventory from the seller to the buyer. So it's really the buyer. If it's FOB shipping point, the buyer owns that inventory as soon as it's shipped out. So if you just take my example and just kind of forget this one, my Nebraska to California example, and Nebraska was the seller in California, I'm the buyer. If I had FOB shipping point, the second that truck leaves Nebraska, then I, as the buyer, own that inventory, and I have to report that on my balance sheet. Okay, so if it ships on December 29th, on December 29th, I, as the buyer, will own that inventory and report on my balance sheet. If the shipping terms, the other shipping term is called FOB destination, in that situation, the seller owns it for the entire time that inventory is in transit. So it stays on the seller's book until such time that that inventory gets to the buyer. So in this situation, in my example, the seller in Nebraska will own that inventory and be responsible for that inventory until it gets to California. Once it gets to California, then it will be transferred on my balance sheet. So on December 31st, it's going to be reported on the seller's balance sheet. And then on January 3rd, when I receive it, it's going to transfer from their balance sheet, and I'm going to record it on my balance sheet. So how do we account for this? So FOB shipping point is the ownership transfer at point of shipping. So let's just go, I'm just going to write here my Nebraska to California, and my Nebraska is my seller. I am the buyer and I'm in California. If the shipping terms say FOB shipping, right? So FOB shipping means that the buyer owns that the buyer, that's me, right? The buyer owns that inventory. The second it leaves Nebraska, the second it leaves its shipping point, that inventory is mine if it's FOB shipping. And the way, so the seller doesn't record anything. Well, the seller record a sale, but in terms of inventory, they don't record anything. Well, they get rid of that inventory on their books. But we're looking at the buyer side. Me as the buyer, I will record that as inventory, and I will debit merchandise inventory and credit cash or accounts payable, depending on how I paid for it. Now, keep in mind, this is what you record under a perpetual inventory system. Under a periodic inventory system, let me go to the next slide real quick. In a periodic inventory system, it's going to be called freight in or transportation in. It's going to be booked to a temporary account, and then it's going to be added to the total purchases, which is adding it to inventory at the end of the period. So just want to, so this is for perpetual, and in the periodic, this would be into transportation or freight in, which is a temporary account. Now, if I'm going to kind of erase all this, right? Now, if my shipping terms say FOB destination, then the ownership transfer, once the inventory gets to its destination point, which in the situations is in California, and the goods are owned by the seller until that point, until this entire time, it is going to be owned by the seller, not the buyer. So if it's FOB destination, the seller is going to own that inventory until it reaches its destination, until the time that it reaches California. The way the seller records any sort of transportation costs, and this is what we're talking about, the transportation costs, right? Because it costs money to transport items from place to place. The seller will debit an expense. It could be delivery expense. Sometimes it's actually cost of goods sold, and if it's delivery expense, it will go into the selling expense portion of the income statement, which are all sorts of expenses that are directly related to inventory, and then credit cash or accounts payable. So it's a little confusing at first, but when you look at this, when you look at this diagram and really like look at it and go through it carefully, I think it makes a little more sense. So just be aware, like I said before, when the freight costs are added in the inventory account, right? When you say debit inventory, credit cash, in the perpetual system, but in the periodic inventory system, there actually goes to the temporary account called freight in or transportation in, which is added to total purchases at the end of the period. So this is really when you have FOB shipping and the buyer is responsible for the inventory as soon as it ships out, and they own that inventory. Shipping charges and outgoing goods, which is really the FOB destination, the costs are not included in the cost of inventory because they're going to be treated as part of their cost of goods or as an operating expense, which is my previous slide said a delivery expense, which is part of the selling expenses. If they are not in the cost of goods sold, though, they are classified, they are often disclosed as such in the notes of the financial statements. Let's go through a quick example. Barrington uses the periodic inventory system. At December 31, 2027, the end of the company's fiscal year, a physical count of inventory revealed that the ending inventory balance was 80,000. That was the ending inventory. And these things happen and they say, what should your ending inventory be? Well, first thing that happened was the merchandise shipped to a customer on December 28th, FOB destination, and did not arrive till the following after year end, to the following year. So FOB destination means the seller still owns that inventory until such time that it gets to its destination. So on December 31st, it had not yet reached the destination, which means it still stays on the seller's books. So that's we should have ending inventory of 3,000. Number 2, merchandise shipped to customer on December 29th, FOB shipping point, and arrived at the customer's location the following year. Well, FOB shipping point, we know that as soon as it leaves the shipping dock, right, then it's the buyer's inventory. So we are the seller, so that's going to be an NA for us as a seller. And then number 3, merchandise purchased from a supplier shipped FOB destination on December 26th, arrived the following year. Well, this is merchandise purchased. So in item number 3, we, Barrington, is the buyer. And so the buyer has, as a buyer, we have FOB destination, which means it doesn't go on our inventory until we actually receive it on January 4th. So on December 31st, that is not on our inventory either. So on December 31st, our ending inventory should be 83,000. So we're talked about the cost of inventory, everything that's included in inventory besides the actually acquiring the actual inventory. It's also the cost that that you need to incur to bring it to its desired condition and or the location for sale, right? So depending on the FOB shipping or destination will determine that. So the product costs associated with inventory include the purchase price of the good, the freight charges on incoming goods by the buyer. So this is if it's FOB shipping, then the buyer incurs it as part of its inventory. Any insurance costs incurred by the buyer while the goods are in transit. So that's, a cost to get it to its location as well. And the cost of any unloading, unpacking, or preparing the inventory for sale or any raw material inventory for use. Let's talk about goods on consignment. This is another item that needs to be included in the inventory. And consignment is when a company sells inventory on behalf of someone or another company. So think of maybe like an art gallery, and I am the artist, right? And I give the art gallery my sculpture, and the art gallery sells the sculpture. The sculpture would be in my inventory, assuming I'm a corporation, in my inventory, not the art gallery. Once the art gallery sells that sculpture, they get a commission for selling that sculpture and I get the rest of the money. But as far as the sculpture as inventory, because let's just say I am in the business of selling sculptures, that sculpture stays in my inventory until such time it is sold, at which point I will expense it to cost of goods sold. That sculpture is never in the art gallery's inventory. It's never considered to be part of their inventory. So in my example, I am the transfer, the signer, the consigner, right? I am the one who makes and sculptures. How do you spell that? I'm the one who makes and sells the sculptures, right? And I retain legal title of all the sculptures, And the consignee, in my example, is the art gallery. They're just selling the sculptures on my behalf, but they never actually own that inventory. That inventory is never on their financials. But the physical good, the sculpture actually transfers, right, from the consignor to the consignee or co-signee, to the co-signee, but they don't actually own that. Right? It doesn't go on their inventory. Alternatively, if a buyer for my sculptures is never found, if a buyer is not found, then the art gallery will just simply return the sculptures to me, and there's nothing needs to be recorded because those sculptures are still on my inventory, in my inventory as the consigner, cosigner. I don't know how you pronounce that really. Okay, so just as a reminder, this is all about what to include in your inventory. And so if you have goods on consignment, it's the company that retains the legal title to it should include it in their inventory. Okay, let's talk about sales returns. When a customer returns items, right? Let's just say I am the seller and a customer returns items back to me. I have to reverse my sales entry, and the way I do that is debit sales return, credit refund liability. But I also have to increase my inventory because that item is back in my inventory. So I'm going to debit inventory and credit cost of goods sold. Additionally, if I have to estimate how much of my inventory may be returned, I have to record that. And so here at the end of 2027, ABC company expects that $70,000 of merchandise will be returned. So this is not actual returned merchandise, it's just expected. And so we have to book a debit sales return, which is a contra sales account. We learned about that in a previous chapter, and credit liability, refund liability. But then I have to increase my inventory balance. But these are for items that have not yet been returned. So there's this account called inventory estimated returns, and I debit it for the cost of those returns that I expect, and credit cost of goods sold. This ending inventory estimated account goes into your ending inventory number on your financial statements. Likewise, on the purchase side or on the buyer side, right? If I make a return, then I have less inventory in my inventory account. So in a perpetual inventory system, if I use a perpetual inventory system, the return of inventory is recorded as a reduction to the inventory account. So I would do credit inventory and debit. Either I get a refund of cash or less accounts payable on my books, right? They reduce the accounts payable that I owe them. In a periodic system, the purchase return the purchase return account is used to accumulate the amount of returns, and then those purchase returns are then subtracted from the total purchases to calculate the net purchases at the end of the period. Now, remember, the net purchases gets added into the inventory account. So the fact that purchase returns are subtracted for it has the same effect as a credit to inventory. It's just kind of a different way of recording it from a perpetual versus periodic system. Let's talk about purchase discount. So I, as a buyer, receive a discount if I pay my invoice within a specific time. So here, let's just say I have an invoice, I purchased some inventory, and their credit terms were 2, 10, and 30, which means I get a 2% discount on the invoice if I pay within 10 days. Otherwise, it's due in 30 days and I pay the full amount. And this is recorded either by the gross method or the net method. We've learned about this in a previous chapter, but let's just go through it real quick because the point of this video is to see how much are we supposed to include in our ending inventory? So that's what I want you to focus on. So on October 5th, we purchased inventory with a cost of $20,000 and the payment terms are stated 210 and 30. So under the gross method, I would just debit inventory for the full amount and credit accounts payable for the full amount. However, under the net method, I assume that I am going to pay it within that 10-day period and therefore get a discount. So when I debit my inventory, it's going to be at, 98%, right? So this is 20,000 times 98%. That assumes a 2% discount. So I would debit my inventory for 19,600 and credit my accounts payable for the same amount. So what happened, so that was October 5th when we acquired when we bought that inventory. On October 14th, right, we're still within that 10-day period, I paid my vendor $13,720, or I should say $14,000 of the $20,000 less 2%. So on the gross method, right, I had booked my accounts payable for the full 20 grand. So now I'm going to debit for the full amount, not taking into account the 2%, I'm going to debit 14,000 and I paid them cash 13,720 because right, that was 14,000 less 2%. But I have to reduce my inventory by $280. So under the gross method, on October 14th, my inventory got reduced by $280. Under the net method, I already recorded my inventory at the net amount, right? We already assume my inventory is going to be 2% less. So I don't need to reduce my inventory for the net method. I just reduce my, I paid cash for $13,720 and I'm going to reduce the accounts payable by that amount. Now, what happens, beyond the 10-day mark, but within the 30-day, I pay the rest of the balance of $6,000. Under the gross method, that's fine. My accounts payable is $6,000 because under the gross method, I had accounts payable. I had credited 20,000 and then debited 14, so I had 6K left. So I'm just going to debit the other 6K to zero it out and credit cash. Under the net method, if I looked at my accounts payable account, I had, I keep doing that. I keep saying accounts payable, right? What did I book for my accounts payable under the net method originally? Oh, yeah, sorry. Oh, under the net method, my accounts payable was 19,600 is what I booked originally, right? Credit. And then I debited 13,720. So the remaining balance in my accounts payable is 5,880, right? But what I paid on November 4th is 6,000. And that difference of $120 goes into purchase discount loss, which some companies have that as a contra sale account, or it might go into cost of goods sold. But either way, it's part of your income statement and does not affect your inventory account. So real quick, Covington Mattress buys mattresses from Simpson Manufacturing. Covington purchased mattresses on August 16th for $12,000 with payment terms of 210 and 30. Covington uses the net method to record purchases. And so Covington should record the purchase at what amount? Well, they should do 12,000 and the net purchase times 98% because we assume that they're going to pay it early. And that amount is 11,660. And so what they're going to do is they're going to debit their inventory for 11,760 and credit accounts payable. But when you're looking at what's your total ending account inventory under the net method, it's 11,760. If they were to use a gross, it would be 12,000. So just to kind of highlight the differences between net and gross will affect what your ending inventory might be.